The Federal Reserve just dropped a bombshell that nobody saw coming, and silver is reacting in a way that could define the entire precious metals market for the rest of 2026. If you are holding silver, or even thinking about buying, you need to hear this before you make your next move. Welcome back to Silver Pulse Analytics. I am your go-to source for the most detailed and data-driven silver market analysis on YouTube. Today we are breaking down exactly how the Federal Reserve's latest interest rate decision in 2026 is reshaping the silver landscape, and what the smartest money in America is doing right now in response. Let me set the stage for where we are in 2026, because the macro environment has shifted dramatically from where we were just 12 months ago. The Federal Reserve has now executed a series of rate cuts that have brought the federal funds rate down significantly from the peak levels we saw in 2024 and early 2025. After holding rates in restrictive territory for over 2 years, the Fed has pivoted decisively toward an easing cycle, and the implications for silver are enormous. According to the CME FedWatch tool, market participants are now pricing in an additional 50 to 75 basis points of cuts through the remainder of 2026, which would bring the Fed funds rate into a range that we have not seen since before the post-pandemic tightening cycle began. Now here is why this matters so much for silver specifically. As of the latest data from the Silver Institute, global silver demand surpassed 1.35 billion ounces in 2025, and early projections for 2026 suggest we could be looking at demand approaching 1.4 billion ounces or higher. Meanwhile, global mine supply has remained essentially flat, hovering around 820 to 840 million ounces per year. That means the structural supply deficit, which has now persisted for 5 consecutive years, is not just continuing, it is widening. When you combine a growing supply gap with a Federal Reserve that is actively making borrowing cheaper and weakening the dollar, you get the kind of environment where silver does not just go up gradually, it has the potential to move explosively. Let me give you the historical context that makes this moment so compelling. If we look back at previous rate-cutting cycles, the data is remarkably consistent. During the 2001 to 2003 easing cycle, silver rose approximately 40%. During the 2007 to 2008 cycle, silver initially dipped with the broader market sell-off, but then rallied over 400% from its lows into 2011, when it nearly touched $50 an ounce. During the 2019 to 2020 cycle, silver doubled from roughly $15 to $30. The pattern is clear. When the Federal Reserve shifts from tightening to easing, silver outperforms nearly every other asset class, and the gains tend to accelerate in the second and third year of the cutting cycle, which is exactly where we are right now in 2026. Let us talk about the dollar, because this is the engine that drives the silver train during rate-cutting cycles. The US dollar index has been under sustained pressure throughout 2026, as lower interest rates make dollar-denominated assets less attractive to global capital. Foreign investors who were piling into US Treasuries when yields were above 5% are now reallocating as those yields compress. According to Treasury International Capital data from the U.S. Department of the Treasury, foreign holdings of U.S. government debt have declined for 3 consecutive quarters, which is putting additional downward pressure on the dollar. For silver, this is pure fuel. Every percentage point decline in the dollar index historically correlates with roughly a 2 to 3% increase in silver prices, and we are seeing that relationship play out in real time right now. Now I need to bring in the China factor because ignoring what is happening in Beijing would be a massive blind spot. China industrial economy remains the single largest driver of physical silver demand on the planet. In 2026, China has accelerated its renewable energy build-out at a pace that has shocked even the most optimistic forecasters. According to the China National Energy Administration, solar panel installations are on track to exceed 350 gigawatts of new capacity in 2026 alone. Each gigawatt of solar capacity requires approximately 25 to 30 metric tons of silver. You do the math on that, and you are looking at over 8,000 to 10,000 metric tons of silver demand just from Chinese solar manufacturing in a single year. That is a staggering number, and it does not even account for silver used in electric vehicles, electronics, and the rapidly expanding AI infrastructure build-out that China is pursuing aggressively. But China is not just consuming silver industrially. There is a significant investment demand story unfolding as well. The People Bank of China has continued diversifying its reserves away from US dollar assets, and while gold has been the primary vehicle, there are credible reports from Reuters and Bloomberg indicating that Chinese state-affiliated entities have been quietly accumulating silver positions through the Shanghai Futures Exchange. Silver withdrawals from the Shanghai Gold Exchange have remained elevated throughout the first half of 2026, running roughly 25% above the 5-year average. When the world's second-largest economy is simultaneously increasing both industrial and investment demand for silver, during a period when the U.S. Federal Reserve is cutting rates and weakening the dollar, you have a convergence of bullish forces that is extraordinarily rare. Let me talk about something that most silver analysts are not discussing enough, and that is the impact of Fed rate cuts on the real economy and how that flows through to industrial silver demand. Lower interest rates do not just make silver more attractive as an investment alternative. They stimulate economic activity across the board. In the United States specifically, lower rates are revitalizing the housing market, which means more construction, more electrical wiring, and more silver used in building materials. The Inflation Reduction Act and its associated clean energy incentives are driving a massive expansion of domestic solar manufacturing, and every single solar panel produced in America requires silver. The CHIPS Act is fueling semiconductor fabrication plant construction across Arizona, Texas, and Ohio, and semiconductors are one of the fastest-growing sources of industrial silver demand. So the Fed rate cuts are creating a positive feedback loop where lower rates boost economic activity, which increases industrial silver consumption, which tightens the already constrained supply picture, which pushes prices higher. Now let us address the real interest rate situation, because this is the indicator that institutional money watches most closely when it comes to precious metals allocation. In 2026, with the Fed having cut rates meaningfully, while inflation has remained sticky in the 2.5 to 3.5% range, depending on which measure you use, real interest rates have moved very close to zero, and by some calculations have already turned negative. According to the Bureau of Labor Statistics, the Core Personal Consumption Expenditures Index, which is the Fed preferred inflation gauge, has been hovering around 2.8%. If the Fed funds rate drops below 3%, which current projections suggest is very possible by late 2026, then real rates go negative. Historically, every single period of sustained negative real rates has produced double-digit annual gains in silver. The 1970s saw silver go from $2 to $50 during a prolonged negative real rate environment. The 2009 to 2012 period saw silver go from $9 to nearly $50. We may not see moves of that exact magnitude, but the directional signal is unmistakable. I also want to address the risk side of the equation, because responsible analysis requires looking at what could go wrong. The biggest threat to the silver bull case in 2026 would be a sudden reversal in Fed policy. If inflation were to spike unexpectedly due to an energy crisis, supply chain disruption, or geopolitical shock, the Fed could be forced to pause cuts or even raise rates, which would strengthen the dollar and create short-term headwinds for silver. Additionally, a severe global recession could temporarily reduce industrial demand, although as I mentioned earlier, silver's safe haven characteristics tend to provide a floor that other industrial metals do not have. There is also the risk of a technological breakthrough that reduces silver usage in solar panels or electronics, although no viable substitute has emerged at scale, and most industry experts believe silver consumption in green technology will continue rising through at least 2030. So what should you be doing with this information right now in 2026? Here is my framework, and I want to be clear, this is analysis, not financial advice. First, you need to be monitoring every single Federal Reserve communication, including FOMC statements, press conferences, dot plot updates, and speeches from Fed governors. The market moves on expectations, not just actual decisions, and being ahead of those expectations is where the real edge is. Second, watch the dollar index like a hawk. If the DXY breaks below key support levels, that will likely trigger algorithmic buying in silver and gold. That could accelerate price moves significantly. Third, pay attention to COMEX registered silver inventories, which have been declining steadily and are now at levels that some analysts consider critically low. If registered inventories continue to drop, it signals that physical demand is overwhelming available supply, which is a precondition for a major price breakout. Fourth, and this is something unique to 2026, watch the U.S. midterm political landscape. Government spending policies, energy legislation, and trade policy all have direct implications for silver demand, and any shifts in Washington could accelerate or decelerate the trends we are discussing today. The bottom line is this: we are sitting in what I believe is one of the most asymmetrically favorable setups for silver in modern market history. The supply deficit is structural and growing. Industrial demand is being supercharged by solar, AI, and electrification. The Federal Reserve is actively cutting rates and weakening the dollar. Real interest rates are approaching or have already crossed into negative territory, and both Western and Eastern capital are increasingly recognizing silver as a critical strategic asset. The pieces are all on the board, and they are pointing in one direction. If this breakdown gave you clarity on where silver is headed and why the Fed is the most important variable to watch, I need you to take 10 seconds right now and subscribe to Silver Pulse Analytics. Hit that notification bell so you get every update the moment it drops. Leave a comment below telling me your silver price target for the end of 2026. I personally read every single comment, and the discussion in this community is one of the best on YouTube. Share this video with anyone who owns silver or is thinking about buying, because the information we covered today could genuinely impact their financial future. This is Silver Pulse Analytics. The data is clear. The setup is historic. Stay locked in, and I will see you in the next update.